All right, so once again, good morning, everybody. We're going to start from chapter 16. That's where we stopped last night. We're trying to see whether we can finish it up. Then before we go ahead. So we're going to try to talk about underwriting considerations. These underwriting considerations we're going to talk now concerns even on the healthcare and health insurance and life insurance. So they're almost the same thing. Remember, in every insurance, there must be application. After the application, what follows is the underwriting process. The underwriting process is always a long process, and most often people are denied during the underwriting process, and people are approved during the underwriting process. So the things that the underwriters consider. Remember, principally in insurance business, we have two underwriters. The underwriters on the field, which is you, the producer, and the agent. You are the field underwriter. Then another underwriter we have is the underwriter in the office. Those one working in the office, they are working for the insurance company. You, the field underwriter, is also working for the insurance company, but you are at the field. So meaning you, the agent, the producer, is also working in hand with the underwriter in the office. So you first got the information about the agent, about the client or the customer. Whatever information you got is what you package in form of application filled by the applicant. You send it to the underwriter. Based on that, the underwriter now have to go to extra length to get more information about that client to decide whether to approve or not to approve. So today, let's go through the underwriting consideration. What the underwriters, what do they consider? More especially in health insurance. The one who have their job, that's what we are considering today. Remember, the one who have their job is the same thing with the individual, but the only difference is that the one who have their job is written as a single contract because it's group. Because it is written as a single contract, they said the owner of that contract is what? The employer. And while you are the employee, should hold the the insurance certificate. Then the owner, the employer, should hold the master contract. That's exactly what the law says. So today we're going to look at those things that the underwriter in the office can consider before they can approve or deny a policy. So let's look at disability insurance underwriting, evaluate an applicant's risk of morbidity. We are now looking at disability. Remember what we are doing in disability insurance. That's what the topic we are into. Disability income insurance. Why do we call it disability income insurance? If you are working and you have this kind of policy, if you are sick, illness or injury that can deprive you from getting your monthly or weekly or bi-weekly income, the disability income insurance will step in to make sure that you continue to get your income. That's exactly what it is. So the definition we have here is quite different from the definition we have on the Social Security, where in the Social Security we consider one is about 3 instances. One is that this person, for you to be disabled, you must have injury or anything that make you have lasted for at least 12 months and may lead to death. You must have lasted for 12 months and may lead to death. That is the most important 2 aspects of it that you should know. That is the definition in terms of Social Security. Now, we are not talking about, we are far from it. We are still going to meet Social Security, I think, in chapter 16, chapter 17 or what. So now let's look at those things the underwriter in the office should consider for approval of their policy in terms of health insurance. So the purpose of disability income underwriting is to protect the insurer. You should know that anytime you hear of underwriting, the purpose of underwriting is to protect the insurer. They don't want the insurer to continue to pay claim that's not worth to be. In life insurance, they don't want to do that. So the underwriting business come in because they want to prevent the series of adverse selection. Adverse selection in the sense that those who are rich, those who are sick, those who are highly at high risk will always seek for life insurance. So that is what is called adverse selection. So before the underwriting process come to life insurance, the adverse selection has been a very big problem in the insurance industry. They keep on losing money in terms of paying claims to people. Because people who are highly sick, people who are at high risk, always seek for life insurance. And then nobody goes through them, nobody see whether they will approve or not. They keep on approving, and insurance companies continue to have what we call adverse selection. So to prevent adverse selection in insurance business, they now organize to introduce what we call underwriters. So the underwriters that they introduce in the insurance business now, they say, all right, since we have introduced all this underwriter, let the underwriting process start with the agent, which is you, the producer. Now, they call you a field underwriter, which means the underwriting process does not start in the office. It starts with you. You go along, you have a client, you have a customer that you talk to about having a policy. You are the first point of call to that business, which means you initiate the business. You ask some questions. So those questions, you gather them in form of application. Now it's sent to the office underwriter to look at it to see whether that person can be approved or not. So the purpose of disability income underwriting is to protect the insurer against adverse selection, which is the main purpose of underwriting, why underwriting was introduced, to prevent adverse selection and to prevent it from happening. They don't want adverse selection to happen at all. Because imagine you, an insurance company, every day you are doing what? You are paying claim. If you pay claim this week, the other week you pay claim. By the time you come to pay it, you run out of business. You will not have money again even to do that. So the only way to protect it is to ensure that those who are supposed to be approved are approved, those who are supposed to be denied are denied. So the underwriting helps to properly classify risks such as preferred, standard, and substandard. Of course, when you start the real business, you see that this risk classification, this place I highlight is the 3 risk classification as far as writing this exam is concerned. Preferred, standard, and substandard classification. These are the 3 risk classifications that you will see in the exam. But when you start the business, you may see more than these 3 risk classifications. We have, apart from preferred, we have the one that is the topmost, which is preferred plus. So these are the other risks that are added. But for your exam sake, the only 3 ones you're supposed to know is what? Preferred, standard, and substandard risk classification. That's the 3 classifications you should know. Then when you go into the business, you now see that there's 2 more or 3 more, which different companies now have their different classification. But however, the standard 3 ones you should know now is preferred, standard, and substandard classification. So that is the purpose of underwriting. They now set up this classification, these 3 classification of risk. They set it up, now begin to marshal out, oh, this person, if Mr. B writes an application, they look at Mr. B, they put him in a class, say, oh, he is preferred. The Mr. C write application, they look at Mr. C, so, oh, Mr. C should be in standard risk. Mr. D write application, they look at it, they say, oh, Mr. D should be in substandard classification. So you see, based on this classification, they are now trying to qualify you on the classification to determine, one, your premium. Your premium. So one of the things that they use in their determination of their premium is what we're going to use today. What we're going to use today. And they are the underwriting consideration. What do they consider? They consider your age, they consider your sex, they consider your occupation. Of course, they consider your overall health. So if you go to life insurance, it's far beyond this. In health insurance, the things they consider is what? Your age, your sex, your gender, and your occupation. But you go to life insurance, it's far beyond this. In life insurance, they're going to thoroughly look at your health. Apart from looking at your head, they want to see your hobby, the kind of thing you do. Whether those things will be of higher risk. Your hobby may be, are you a smoker? Are you a drunkard? Now, they went ahead to look at your social life. Your social life. Of course, they will go as far as even looking to see your driving records. So all those in there is what the underwriters consider when you talk about life insurance. But for heads, the most important thing for them is their age, their sex, occupation. More especially in group insurance. But if it's not if it's individual and under Obamacare, they're going to look at pre-existing condition, but they're going to look from now to 6 months. They don't look beyond 6 months. So individuals in certain professions, such as physicians, attorneys, and engaging in less hazardous lines of work, also, their income potential is much higher than their potential benefit. If this individual becomes disabled, they are more likely to attempt to return to their respective practice. So remember, we are considering disability. Imagine somebody who is a physician, somebody who is an attorney. These two professions, if in any way they got disabled, don't you think they can still go to their work? If anything happened to their leg, if anything happened to their hands, if they can no longer walk, don't you think they can go to their job? They will. So this kind of people apply for disability insurance, and somebody who is who let's assume somebody who is works in industry, where carry maybe somebody who's a diver or a swimmer, somebody who is professionally a swimmer. If he gets disabled, do you think he can still do his job? No. But somebody who's a physician or attorney can still sit on a chair. As far as his mouth, he can still see and hear and speak. He can still do his job. A physician can never be disabled. The disability that makes a physician not to work is that disability that affected his speaking, his reasoning, and probably his eye. Some physicians, even if they may not see, if you tell them your symptom, they'll tell you what's the problem with you. They will. The only problem is that they may not be able to make a research. But an attorney, except you close an attorney mouth, he is also always there. No disability affects him, except that disability affects his reason, his mental health. That's when he will totally be out of work. So as some other jobs too. But for those jobs of higher risk, if they apply for disability, you see that those people, their premium will be higher. If a physician or attorney apply for a disability, or somebody who just work in office, the person is a clerk in the office, apply for disability, and somebody who work in a construction company, apply for a disability, don't you think the person who work in the office, the clerk in the office, the premium for that clerk will be less than that of person who work in a construction company? Because if anything happened, the person who work in a construction company can no longer work. But a clerk can still be in a wheelchair and go to his office and stay and work. After all, some people who are disabled are still participating in politics, doing great things in politics. Yes, they're still doing great things in politics, doing great things in their businesses. I know of one man from our side, he's disabled, he's crippled. He doesn't work, but he's a millionaire up to today. He's still doing his coordinating his business, he has still have a wonderful family. So if he is not, if he works in a construction company and such a thing happen, do you think he can still do nothing? He cannot do anything again. He's crippled while he's working in a construction company. He can never be able to do so. The disability in such aspect may be higher. So he said, if individuals become disabled, they are more likely to attempt to return to their respective practices, of course. Other white and gray collar occupations are seen as riskier, especially when the incentive to return to work is lower. Many blue collar occupations have a higher incidence of physical injury and the highest morbidity rates. In such cases, what happens? The insurer will limit policy returns and the benefit period to either 2 or 5 years. So you see, because the problem here is the benefit period. For individual physicians, we have a longer benefit period. For a construction worker, we have a very shorter benefit period of 2 to 5 years. I hope everybody remember what benefit period is. Who doesn't understand what benefit period is? I hope everybody here should understand what it is. Anybody who doesn't understand what benefit period is? So you can see that the physician, the attorney, we have a longer benefit period. And a construction worker who have a more riskier job, we have what? A shorter benefit period of 2 to 5 years. But a physician may have up to 10 years benefit period. Yeah. Because they know his disability cannot, the kind of disability that can affect him not to work is disability that affects his reasoning, more especially. So let's look at individual disability income policy riders. In every insurance, there's always a policy rider. You may have a policy, you don't have a rider on it. You just buy one single thing. But if you have a rider on your policy, believe you me, if you have a rider on your policy, you have all. However, riders do not come by, they don't just give it to you. You get it, you pay for it. So that is rider. I normally like to use, I say somebody go and buy pizza. Maybe me and, who is here? Me and Maria, we went to buy pizza. Maria decided to buy, when we're on the same car, we decided we're going to buy veggie pizza. So Maria go, when I get there, I was so hungry. The veggie pizza, one box is $20. I just buy the normal veggie pizza and tell Maria I'm okay. Maria said, no, he don't want his own to be rich. Maria will put all the vegetables, all the pineapple, avocado, mushroom, everything. When she add all those things, pineapple, she continue to add all those things to her pizza. When she added all those things, finished. Me, I bought the same veggie pizza, $20. And when she add all those things that she needed, she's not gonna pay $20. She'll pay close to $50 to $60. So those things she add there are just like riders in insurance. You add riders in insurance to make it more beneficial. So if I now buy 500,000 life insurance and you buy the same 500 life insurance, we are of the same age. We are the same sex. We are everything the same. No health issue. And I bought my own 500,000 policy, and I'm required to pay maybe $300 monthly. Now, I have only the maximum, the 3 good riders which are inbuilt on the policy. I'm going to pay $300. But you decide to add more riders on your policy. Apart from the 3 maximum one they can give you free, you now want to add other riders, just like AD&D. Try to add every rider you know that can benefit you. Even you add disability insurance onto it as a rider, you add all those in. You will not be paying $300 and paying. You're going to pay up to $500 every month. Because now your own policy is rich, more beneficial than mine. So that's what riders is. So policyholders may add additional coverage for additional premium. Some riders add benefit for particular types of losses or in specific circumstances. You add riders based on your needs. That's why I said when you are writing policy, by now that you're getting this knowledge, you don't just write policy because you want to write policy. You write policy with an intent to get a particular thing. You direct your policy to your own personal and family needs. That's what it is. Then what can help you to do that is riders. You can decide to say, this my son drives rough. I'm going to add disability rider on his or her policy. You put a disability rider on it. They won't expect you to pay the same premium with somebody who his son is not driving so rough. That person may not put disability insurance rider. You may not put it, but you've seen this circumstance surrounding your family. You want to maximize the policy by making it more beneficial to the family, by adding some things that other people do not add to benefit you. So that's what riders is. So other addresses the need to adjust coverage limit to benefit over time. Still, others help insured extend their buying power by considering the availability of social insurance. Let's examine the variety of policy options. So let's look at some of the policy options. Accidental death and dismemberment, AD&D. This accidental death and dismemberment, you can get it as a rider. You can equally have it as what? A policy. Just like long-term care. You can have long-term care as a rider. You can equally have it as a single policy. So for AD&D, the benefit applies if an accident results in a catastrophic loss. Catastrophic loss. If you have AD&D and you had an accident, remember, AD&D is accidental death and dismemberment policy or rider. If you have it, that person, that death or anything or that loss must be through accident. And it must be somehow catastrophic before you can be able to get the benefit that applies to it. So, which is defined as death. The AD&D loss can be death, permanent loss of limbs, or permanent loss of one or more of the senses, sight, hearing, and speech. Limbs, legs, and hand, senses, loss of sight, loss of hearing, and loss of speech. Those are what should be considered in AD&D, accidental death and dismemberment policy. All right. So the death benefit paid under accidental death coverage is referred to as the principal sum. The death benefit paid to this person who has this policy or who have it as a rider is what we call what? Principal sum. Now, the dismemberment benefit refers as the capital sum. If you have this policy, AD&D, and you have a loss, the death benefit paid to you is what we call the capital sum. I mean, the principal sum. Now, the dismemberment benefit is two things you're going to get on this policy if you have it. So imagine you have it as a rider. Of course, most often they don't want to give it as a rider, particularly to men. They don't want to give it as a rider to men because of the risk, because of men are highly risk and they die easily. So they don't want to consider giving it to men. They reduce the premium if they want to give it to men. But for women, the premium can be of normal. So AD&D, you have it, the principal sum is the death benefit you have, and the capital sum is the dismemberment benefit. So in it, you have two types of what? Benefit. One is the death benefit, and the next one is what? The dismemberment benefit, which means you can still be alive and still have one of the benefits, just like dismemberment benefit. You can be alive and get your dismemberment benefit. Then if the person dies, then the person will get what? The accidental death benefit, which is called the principal sum. Then the dismemberment benefit is called what? The capital sum. So the principal sum is the rider's face amount. I hope everybody's following. The principal sum now is the rider's face amount. What is that face amount? The amount that person bought the policy for. That is the principal sum. And that is the what? The rider's face amount. Why the capital sum is typically 50% of the principal sum. So imagine somebody have a $1 million policy on this AD&D, and the person lost his arm. Since it's $1 million policy, how much is going to get? 50% of that 1 million, which is 500,000. Then if the person now dies, this is where it gets tricky, why they're afraid of it. If the person dies, the person will get what? 1 million benefit as the principal sum, because that is the first amount. And again, another 500, which is the capital sum, which is the dismemberment benefit. So you can see that based on that, most companies will be afraid of that. So an accidental death benefit may be available up to a limited age of 70. After age of 70, they don't do it again. Also, death must generally occur within 90 days of the accident to qualify. They put a lot of clauses on it. So if somebody has that accident, for that accident to qualify to receive the benefit, that death must have occurred 90 days after the accident. So when accidental death coverage is added to a disability income insurance policy, what the insured must designate a primary beneficiary. Of course, you always have to put your primary beneficiary, otherwise your benefits go to probate court, go to your estate, you go to probate court. So premium paid in this type of coverage are not tax deductible. That is, they are paid after tax. However, the benefit payable to the insured or beneficiary are not taxable. There is no benefit paid to any insurance that is taxable. All of them are not taxable. Benefits are not taxable. Please know that. So some refer AD&D coverage as multiple indemnity coverage. Of course, it's multiple indemnity coverage. Since they will pay you principal sum and pay his capital sum, it's multiple indemnity coverage because they pay you twice, two things in one policy, the death and the dismemberment section of it, which is the dismemberment section is called the capital sum. The death part of it is called what? The principal sum. And that principal sum is the first amount of the what? Of the policy. If you write 2 million, the principal sum is what? The first amount of the policy. That's 2 million now becomes the principal sum. They pay you the principal sum. Then if you qualify, as they said, they will not pay you the capital sum, which is if you 2 million, then the capital sum should be 1 million because it's 50% of the principal sum. Any question? Any question? All right. Social insurance supplements. This is social security rider. Of course, just like we say social security is what? Is a social insurance. So you still have a rider, social security rider, coordinate individual disability policy benefit with social security disability insurance. And remember, in social security, we still have disability insurance on it. Social security is an insurance. So we have social security disability insurance, SSDI, and other forms of social insurance, e.g., workers' compensation. This rider is commonly referred to as social security supplements. So the riders in social security, such as social security disability insurance, SSDI, are considered what? Social insurance supplements. It pays the insured monthly benefit when SSDI or workers' compensation denies or does not cover a claim. Let us not go. We're still going to miss social security. There's no need. Additional monthly. Let's go ahead. Guarantee insurability rider. which is additional purchase of future increase option. There's one thing we're going to do, and whenever we're going to do it, I want those who are available to pay attention to it. Benefits are distributed based on what is the contract. And what is that contract is what the owner of the policy, designed it to be. So there's so many ways benefits can be distributed. We're going to see so many ways that benefit can be distributed. Most times, it's very, very important in the exam. So let's look at guarantee insurability rider. The future increase option rider, which helps guarantees that person's coverage keep pace with income. The future increase option. Individual policy define a person's monthly benefit as flat amount that don't automatically change in their home. The FIO, which is the future increase option, guarantees that the insured can purchase additional amount of disability income insurance at various specific features that without evidence of insurability. There's future increase option rider. If you have this rider in your disability insurance, the future increase option, you can at any time buy more policy without them asking you for evidence of insurability. Remember what I said yesterday? I said you can decrease your first amount, but you cannot increase it. Insurance company can help you to decrease your first amount, but they cannot increase it. Why? They have to consider the health condition again. So, but if you have a future increase option, FIO rider, what does it do? It helps you to increase your first amount without any evidence of insurability. Did everybody understood that? Future increase option is a rider that's in disability income insurance. If you have it, you can increase your policy amount at any time you want. But remember, naturally, when you after writing the policy, the insurance company or you cannot increase your first amount, but you can decrease it. But if you have a future increase option, FIO rider, you can automatically, at any time you want, it guarantee you what? Increase in your first amount. That increase also is a purchase. You can purchase more without them asking you whether you have any evidence of insurability. They will not ask you that. But ordinarily, you cannot write policy and increase the first amount. You have during the free look period to increase it. If you cannot do anything with that free look period, if the contract becomes binding, you can no longer do that. What they tell you now is to go and write another policy. Open up another policy. That's what they said. So the insured can exercise this option as long as their income has increased over the years. Also, the insured must exercise the FIO if available. The terms of the guaranteed insurability rider are used to or lose it. Either you use it or you lose it. Remember the contract of adhesion. Who remember contract of adhesion? Either you take it or you leave it. So for guaranteed insurability, as either you use it or you lose it. If you don't use it, you lose it. So if you have FIO, you can increase your first amount. Yeah, you can purchase additional amount of disability income insurance, adding to the one you have. If you have the rider, FIO. So the restriction helps insurer avoid adverse selection because insurance company may also refer to this benefit as additional purchase option, APO, or guarantee purchase option, GPO. All right, cost of living adjustment rider. This is another rider you can have in disability income insurance. You see, all those things, they made all those provisions to you. So for somebody who just go and buy disability insurance, if you're telling him all this benefit here, he thinks you are lying. So, but you know what you want. You sit down to design what you want. Believe me, most of this may not be as pricey as we may think. Maybe $10 added or $20 added. I'm telling you. All this is maybe $10, $10 added. So the best thing is to find out whether if you need it, then find out what it costs. So let's look at cost of living adjustment rider. This one helped them to fight inflation. Cost of living adjustment COLA rider offset the impact of inflation that can erode the purchasing power of fixed income, such as that provided by monthly disability income benefit. So if I'm to buy this, of course, if I'm buying it now, I have it, but I can no longer do any adjustment because the contract is binding. But if I'm to do it now, I must put this cost of living adjustment rider. Yes. What does it do? If you have been in your job, you are being paid $1,000. Let's assume $1,000 every month. Now you have the insurance, disability insurance. By the time they do the calculation and remove her, you might be paying you around $700 every month. Now, if you have a cost of living adjustment rider, COLA, what are you going to do? Because they have the rider, they're going to increase it to the amount or even more when they do their calculation based on their contribution. So you see that it's better for it to have it. It's good to have. It's good. It's good to have, I tell you. Let's look at this example. It said, for example, 1,000 per month benefit with COLA rider may be increased each year by the lesser of the CPI inflation rate or a specified percentage stated in the policy, generally 5%. So each year it increases 5%. Why? I love it. This one is lifetime extension rider. The lifetime extension rider will extend the benefit period beyond the age of 65. Remember what we said yesterday? That
Robert, I have a question.
Go ahead.
So this is only in disability insurance, is it?
Yes. This one
It
was saying
doesn't,
only disability insurance, yes.
okay. It doesn't apply in other regular
Yeah, you
insurance.
see right that resemble these ones, other regular insurance. You still see them. When we go to life insurance, you still see them. But because we don't do much, and more especially we are being hindered by what we can afford. You understand? So most of this are not looked into. But if you know it, you as an agent can design your own policy the way you want it. That's what I always say. Always, knowing you can design your policy. You may not write your own policy, but you can design it. If assume your daughter or your son or your colleague or the person that brought you the business, you can design your own policy. Look at what I want. Please write this policy for me. Look at what I want. Put this, put this, put that. When the person is writing, you'll be there with him. You type it, it's fast. You're going to type it. Don't you you're gonna do everything. You're gonna do the application. The only thing you may do is to bring the person to put his code and put his signature. You understand? Because you know it. You know exactly what you want. You don't need another person to tell you what you want. You cannot write the policy for yourself. Somebody working with you can do that. Yeah, the person who brings you the business can do that. Or anybody you trust can do that for you. Or even you can give it to one of your people you recruit to write for you. Then you have designed this. You tell them, look at this. They now use listen to submit it for you because you cannot use your own code, your own code to submit it. It can be the applicant and also the agent. You understand? So you can give somebody to do it. By then you have already designed what you want. Nobody will stop you. Nobody will tell you. You know what you want. Do it as you want it. Sorry, give me a second, please. All right, so that's what it is. Do your own thing the way you want it. So let's look at lifetime extensor rider. Of course, remember we talked about 65 years. You can now extend their benefits. The benefit maximum age they can extend benefits is 5 years. If you have a lifetime extensor rider, you can extend it beyond 65 years. So, see, there's a lot of things you can do. Like this lifetime extension now, if you put it as a rider to your policy, it may be small. It may be the money may be additional $10 or additional $20. Of course, you will not be talking about 65 years. You may be talking about 75 to 80 years. So this thing is based on how much you can afford, how much you think you afford, and what you want. You remember we talk about hospital and home confinement. That is a rider, hospital confinement rider. If you have hospital confinement rider, you're expected to be indoors, confined to a hospital. If you're disabled, if you have home confinement, you're expected to be at home. You're not expected to be going around. Some people, though I told you yesterday, some people, when we were doing home health, some people have workers' compensation and they are receiving benefit from workers' comp. And you see them still going to work, going to clock in somewhere and be working. So if you discover such a thing or your agency, the best thing you do is to discharge such patient because you're gonna put it into trouble. So that's what it is. So if you have a hospital confinement rider, what it means that you are disabled and it's gonna be in the hospital. You're not expected to be walking around. So, but you see, sometimes if you're working in the hospital, you see that some people, there are some patients you cannot even restrict. You cannot tell them to sit down. They may be in the hospital, they're going around, going to do their things. So now let's look at return of premium rider. This return of premium rider is most important in term life insurance. Of course, if you don't have it, you have lost your money. That's the truth. If you don't have return of premium rider in your term life insurance, if any of us have term life insurance, you don't have return of premium rider, you better go and find out. If you don't have it, the money you're paying there is at loss, except you think you may not live live up to the term. Which means if you don't live up to the term, if the person died before the term, the beneficiary will get the money. But if you did not die before the term, you don't have to turn a premium rider. You lose it. You lose your whole money. So I hope everybody knows that. You have term insurance, that's one of the first thing you check out. If you have return on premium rider, all your premium will be returned to you if you cannot be able to continue with the policy. But however, they will remove all the administrative charges. Then the remaining money, they will give it back to you. But if you do not have anything, you are going to lose all if you can't continue, can't renew it. So I hope everybody knows that. So the return of premium rider provision, refund provision for the insured. It includes the refunds, it refunds a percentage of all premium paid during a specific period, provided there has been a favorable claim experience. This rider may provide refunds at the age of 65 or every 5 or 10 years after the policy is issued, depending on the insurer. So it's you. You determine that you're going to get your money back. You get it, which means at the time you are doing the writing the policy, ask them, do I have return on premium rider? They will include it. You're gonna remember it's a rider. When they increase, you have to pay a little bit of money. So if it's a policy you're going to pay $100, you put return on premium rider, you may pay $110 or $105 or $115, as the case may be. So cash surrender value rider. Do we have cash surrender value rider in term insurance? Of course, no. Do we have it in disability insurance? Of course. Is it workable? I've not even seen it work. So a cash surrender value rider returns all premium to the policy owner at age 65, less any benefit received over the contract life. So that is exactly, if you have it in life insurance, cash surrender value, it's automatic. That rider is automatic. If you have it in permanent or whole life insurance, cash surrender is automatic. And because it's automatic, we call it non-forfeiture. Remember, we call it non-forfeiture. Who remember the word non-forfeiture?
Yes.
Non-forfeiture is cash value, which means no matter what happens, you're gonna get your money back. But however, are you gonna get 100% of your premium? No. So cash value is like you have a return of premium rider in term life insurance. But the only difference is in permanent or whole life, the cash value builds wealth for you. But return of premium rider does not do that. Of course, term life insurance does not have a cash value. So there are two types of disability benefit that are found in life insurance. Two types of disability benefit that are found in life insurance. One of them is waiver of premium rider. And the next one, disability income rider. Waiver of premium rider and disability income rider are the two riders found in disability benefits. So please know that waiver of premium rider and disability income rider, they are the two types of disability benefit that are found in life insurance. Waiver of premium rider and disability income rider. So the waiver of premium rider is a provision that waives the cost of coverage if the insured become disabled. It waives the cost of coverage, which means the premium are waived from you and the policy is still intact if the person become disabled. So it is optional in life insurance. Waiver of premium rider is optional, of course, but standard in health insurance contracts. So waiver of premium rider is a standard provision in health insurance contract. You do not need to add it again. It's there. It's a standard provision, which means it does exist in health insurance policies. So on the other hand, disability income benefit rider provide for a small stated benefit, such as 1% of the policy face amount up to 1,000 that is payable if the insured become totally disabled.
Huh?
That disability income rider. It provides extra 1% of the total of the first amount. So 1% of the first amount, that is $1,000. May not be 1,000. If you have first amount 500, the 1% be 500, will be 1,000. No. So that disability income rider. Business uses for disability insurance. Like we have gone this one before. I don't know. You're not gonna look at it. Group disability income insurance plan. To me, I feel like we have done this before.
Yeah.
Eh? Yeah.
Uh-huh.
It's like we have done it before. All right. A group disability income insurance plan. Group plan must be natural group, of course, just like in life insurance or group insurance. You cannot, as an entity, maybe you guys have a union, you form the union for the process of, for aiming to get policy, life insurance policy. No. You must form the group for another thing, then you guys can go for group insurance. But you cannot form it with the aim to go and get group insurance. They will not approve that. So insurance company determine premiums based on group aggregate level of risk, of course, taking into account its industries. An employer may offer more than one, but we'll not go to all this. Let's leave it and go.
Robert, what is a waiver of premium? What does it do?
Waiver of premium is, all right, in health insurance is a compulsory provision. What you do is that at a point the person become disabled, they waive premium for you. Waiving premium means that you can no longer, because you are disabled, you can no longer pay your premium. But your policy is still intact, it's still active. They'll be paying the premium for you. It does also apply in life insurance, waiver of premium, yes. But in health insurance is a provision, which means it's inbuilt in the policy. If you get disabled, remember when you stop paying your premium, what happened to your policy? It terminates. Huh?
Mm-hmm.
Yeah, you lose it. In term insurance, you lose it. If you can't be able to do what? Pay it. But if disability insurance, if they have a waiver of premium rider, even if you cannot be able to pay, the policy does not terminate. The policy will start paying itself because you have this rider, waiver of premium rider.
So if you said it is standard
Mm-hmm.
in medical insurance,
Mm-hmm.
does that mean that whether you take it as a rider or not, if you have medical insurance and you become disabled, that
Mm-hmm.
it will automatically, the waiver will be, or the premium will be waived?
Yes, that's what it's supposed to be. From what
Okay.
we read here, but what a question we ask ourselves again, is it applicable in the insurance industry? You understand?
Yeah.
Yeah, that's what we ask. But of course, you see, most of the time, if you're in the hospital, you have policy. It's continue to go, even if you don't pay the premium. They continue to pay you for the fact um they have opened up elimination period and benefit period. That benefit period does not end until you're out from there. You remember? So the benefit period continues. That's waiver of premium rider acting there because you're no longer paying the premium because you are disabled. You can no longer do anything. But the benefit period continues. So it's there. But in life insurance, it's not automatic. You have to ask for it. It's a rider. You have to ask for it. Then in cash value life insurance, in cash value life insurance is always there. Yeah, in cash value life insurance, it is there because it has a cash value. If you pay at a point you couldn't be able to pay again, the automatic waiver of premium rider will step in. That is the cash value, whatever you accumulate to the cash value, start paying your premium. Your policy does not lapse. That one is automatic. So waiver of premium do a lot of things in life insurance. A lot, a lot. Qualifying for benefit and benefit periods. We don't need to go through this again. We have long-term benefit period and short-term benefit period. We have done this.
Okay.
Yeah, you see this, we did this yesterday. You see, remember it, probational period, benefit period, and elimination. We did it yesterday, and it took a lot of our time.
Okay, so let's move on.
Yeah. Oh my God. Yeah, we have done all this. I say we have done this. The people that benefit are those who are not here last night. Disability buyout. Yeah, we did all this. Oh my God. Disability buyout policy entity plans. Um, Elective indemnity option. All right, let's look at, I don't know. Let me see this one. Person employees. All right, let's start from this elective indemnity option. Of some disability income policy provide an optional lump sum payment rather than stream of periodic payment for injuries named in the contract. You see, there's another thing all of us should know, and of course, when you start a business, when you start a business, you know the impact having a policy is. And believe you me, you have more policy. More policy because you now understand what it is. You now understand it's like, more especially cash value life insurance policy. You now understand that these policies are just like you opening a bank, different bank of your own. I'm telling you. And if you know it, now you'll be having a lot of policies on your name. Because you're no longer looking at it as for death benefit. No. You're looking at it as a section of your bank where you can go and take money and do whatever you want to do. If you take money from there, you pay less interest. Any money you can take and pay less interest and do what you want to do, don't you think is the best thing to you? If you go to a bank now and say you want to get $100,000 loan, I'm telling you the truth, before you feed the paper finish, before you're able to meet up their demands, it'll be very difficult. But if you have a cash value life insurance that have a good accumulation of cash value, You go there and take 100,000. You can take it as a loan or withdrawal. But more especially, we advise people to take it as a loan. Take it as a withdrawal. You are killing the hen that's what? They're laying the
Lay
egg.
the golden eggs.
Yeah, so just take it as a loan. Pay the percentage. How many percentage? 2%. 2%. Go to bank, get $100,000. Let me see how many percentage they will give you. You may reach up to 40, 30 something percent. And you bring that 100,000, paying 2%. And who are you paying the 2% to? You are paying it to yourself. I told you of one lady, she's an SMD. She said she just look at her home. She have almost 230 or 240,000 remaining to pay off the home. She check how much she's paying the mortgage people. She look at her cash value life insurance. She has more than that on the policy. She went ahead and go and withdraw money from take a loan from her policy. Go and pay off the home. She paid off the home, and now she is paying back the money in her in her policy, paying 2% interest. And the good thing about that is that she is paying the interest to herself. So if she don't want to see because in your home mortgage payment, you are paying you are using compound interest in paying what you're paying. That's why it does not end. He continues to pay. He continues to pay. You are paying for loan, paying back your auto loan. It does not end. You are paying your student loan. It does not end because they are using compound interest to keep on compounding for you.
Oh, Jesus
You pay
Christ.
today, tomorrow, what you pay is back. So you see that lady that did that thing is one of the best thing anybody can do. You know what it means? You have reduced, oh my God, you have reduced the burden. One, you don't have mortgage again. Two, you are paying the money to yourself. So there's nothing can tell me there's more than this, I'm telling you. But the good thing is that what is more beneficial if you have known and started on time. Yes, it's more beneficial. By now, you should have good money there. Imagine somebody who started cash value life insurance by 25 years, $1 million by 25 years. You know how much it will be? Or $1 million by 30. You know how much you're going to be by now? If that person, by the time that person clock off to 50 years, you know how much will be there? It's big money. It's big money.
Engineer, I have a question.
But
Yes, how do you accumulate that cash value on your policy? Where is that money coming from? You
all right.
pay extra in, or how do you?
No, all right. Let me tell you how it come from. I think
Mm.
we will equally going to see it. When you pay a premium,
Mm.
when you pay a premium, your premium is distributed to so many, let me use the word ranks, or so many routes. They're routed to so many areas. So what part of the premium will go to cost of insurance? You know, every insurance have cost of insurance. What part of another part of the premium again will go to commissions, which they pay to agent. Part of the premium will go to what? Expenses, company expenses to maintain the policy. Then part of the premium will go to cash value. The one that goes to cash value is the one that builds all this cash for you. Because when you go there, to the one they route to cash value, percentage of it routed to cash value. When you go there, you see that they're going to use compound and index method to be able to get you money. So if the market is so good, it's compounding. The index is indexed. When it's indexed, it means that you will not lose. You only participate in the gain. So meaning the one that goes there will be compounded as your mortgage is compounded, you are paying. So that those one that one that go there will be compounding for you, getting more money for you. So that's where it come from. That's why they
Okay.
said the cash value is what? Non for future. So the part that goes to cash value is the one that giving you back. They like investing it for you. Is that clear?
Yeah, yeah. Thank you.
That tells you that when you have a policy, you are paying monthly, you are directly cheating yourself because you're not making much impact on your cash value. But if you pay annually, then you are putting more money on your cash value, meaning your money is going to grow more.
Oh, really?
Yes. But if you pay monthly, you are barely trying to survive the policy.
Oh.
Yeah. So some people will even go as far as doing what we call 7-pay. You're going, apart from paying the annually, you still add more money to your policy because in every policy, there's what we call 7-pay, the maximum amount you can put in that policy for some period. So some people continue to put money in their policy. Some people use it as their own bank. That's the truth.
Mm.
Yeah. So because the more you put there, the more accumulation you have on your cash value. Because what you want to see in your cash value, you want to see bigger money in your cash value. So that if anything come up, you can go there and get money. Yeah. All right. So key person's employee disability in insurance, you still have key person policy. Key person in policy is that person, that staff, or that person you employed in your company that is performing the job. That if that person is not there, what happened? The jobs will suffer. So that person is a key employee. That key employee, you can put insurance on that key employee. You can equally put disability income insurance to that person. So that if anything happens to that person, maybe that person have accident or anything, what happened? Your company will not suffer. Your company will have benefit. Use that benefit to train another person who will work in place of that person who injured. Or if the person dies, use the benefit to what? Continue to hire another person and train other people. So there's a much to benefit when you have key employee policy. So you can have it as key employee policy in life insurance. You can only have it in disability insurance. And the good thing about key employee policy, the company is paying the premium. And again, it's in as much as they're paying the premium is going as company expense during tax filing. All right, so let's go. Group disability income insurance plan. We have talked about this. I think we almost talked about all this. Taxation. Let's see of taxation disability insurance policy. When it comes to disability insurance, the fundamental taxation principle is that the IRS generally taxes the money only once. Let's look at what they tax. They say they taxes the money only once. The IRS either tax the premium paid or the benefit received, but not both sides of the cash flow for the same transaction. So the IRS tax the premium paid or the benefit received. That is for disability. You know why they are taxing it? Because it's an income. Do they tax benefit on life insurance? Not at all. But remember, this one is disability income insurance. It's replacing the income you are making when you are working. Remember, this is when you are working, when you do not have disability, you're working, the IRS tax your income. Is that true?
Yeah.
Yeah, they tax your income. Now that you're not working, what replaces your income is the disability income insurance you have. It now replaces your income. The IRS come around again to tax you. They are going to tax the premium or they tax the benefits you are receiving. So most times people will prefer them to tax the premium. But they're not going to tax the premium and the benefits. So you can now see the reason why they are taxing it. Because it's a replacement of your income. So the IRS can tax the money going in or coming out, but it cannot tax it both coming in and going. The following section examine how this applies to the various forms of disability insurance covered in this chapter. So you can see the IRS tax them They tax them because the replacement of income. Since you pay income when you are not when you are working, now you are disabled. The income is coming in forms of disability insurance. They're still gonna tax you. They tax you, but they tax either they tax the premium or they tax the benefit. Either they come in, they tax the coming in, or they tax the going out. So all right, I think we're not going to look at social security disability. We're going to see social security in the next chapter. Individual disability income insurance. All right. Firstly, let's look at this. Individual disability income insurance taxation. The taxation of individual disability income insurance policy is as follows. Premiums are not deductible because premiums are not taxable, tax deductible. The IRS count the premium as part of the taxable income and captures a percentage as income tax. Therefore, a person pays the premium with after-tax dollar. Now, benefits are not taxable because the premium have been paid in after-tax dollar. So whenever you pay a premium with after-tax dollar, they're not going to tax the benefit at all. So that is it. That is it. All right. Benefits are not taxable, of course. Group disability income insurance, employees. It's like we almost have talked everything here. We talked everything on our analysis. I want us to go to chapter 17. Yep, we have got all those things. Again, so. All right, I think here we go. Let's answer questions, then see what we can do in chapter 5. Well, let's watch this. Let's watch the video. You can jot down anything you see here. Watch the video. This is a chapter summary video.
Excellent work completing the disability income insurance chapter. You've navigated the complex world of disability coverage and its importance in financial planning. Let's review the key concepts to reinforce your understanding. We began by examining the fundamental purpose of disability insurance, to replace a portion of income when a covered person cannot work due to a qualifying disability. While most people understand the need for life insurance, many overlook disability coverage despite the fact that working-age individuals are more likely to become disabled than to die prematurely. We learned that disability can be defined in various ways, with a significant impact on when and how benefits are paid. The own occupation definition of disability is the most favorable for policyholders. Under this definition, an individual is considered disabled if they are unable to perform the specific duties of their own job or profession, even if they are capable of working in another role. This distinction is especially important for professionals with specialized skills, as it ensures coverage even when they cannot return to their exact occupation. Because of its broader protection, policies with the own occupation definition typically come with higher premiums. The any occupation definition of disability is more restrictive and commonly used in long-term disability policies. Under this definition, an individual is considered disabled only if they are unable to perform any job for which they are reasonably qualified based on their education, training, or experience. This means that even if someone cannot return to their previous role, they may not be eligible for benefits if they can perform another job within their skill set. This definition is often applied after an initial period of own occupation coverage. And the Social Security definition requires inability to engage in any substantial gainful activity due to a condition expected to last at least 12 months or result in death. This is the most restrictive definition and requires meeting strict eligibility criteria. We compared government disability programs and private insurance options that serve different roles in income protection planning. While programs like Social Security disability insurance and workers' compensation offer basic coverage, they come with strict eligibility requirements and often provide limited benefits. For example, SSDI requires a significant work history and proof of long-term disability, while workers' compensation only applies to work-related injuries or illnesses. These limitations highlight the importance of supplemental private disability insurance, which can offer broader coverage and more flexible benefit structures. Let's talk about two key government programs you'll need to know for the exam: Social Security Disability Insurance, SSDI, and Workers' Compensation. With Social Security, there are a couple of important things to remember. First, there's a 5-month waiting period, so even if someone qualifies, they won't receive benefits right away. Second, they must be fully insured, which means they've paid enough into the system through FICA taxes over their working years. Workers' compensation works a bit differently. It only covers disabilities that happen on the job, and it often coordinates with other benefits, which can reduce the total amount someone receives. These limitations are exactly why private disability insurance is so important. It fills the gaps and offers more flexible, reliable coverage. We distinguish between individual and group disability policies. Individual policies provide 24/7 coverage with benefits defined as flat amounts. They typically limit coverage to 60% of gross income or 80% of net income. Group policies often provide non-occupational coverage that coordinates with workers' compensation. They use a percentage of earnings approach that automatically adjusts with income changes and typically cover 50 to 70% of income. Both types can be structured as short-term or long-term coverage. Short-term disability provides benefits for up to 2 years with minimal waiting periods, while long-term disability offers benefit periods from 2 years to age 65 with longer elimination periods. For businesses, we explored specialized disability insurance products. Business overhead expense insurance covers ongoing operational costs if the owner becomes disabled, ensuring the business can continue operating during the owner's absence. Disability buyout policies fund the purchase of a disabled partner's share, available as either cross-purchase plans between partners or entity plans, company purchases. These policies typically have lengthy elimination periods of up to 2 years. Key person disability insurance compensates a business for the loss of essential personnel by covering the costs of hiring and training replacements. The business is usually the owner, premium payer, and beneficiary of these policies. Finally, we examined how disability benefits are taxed, noting the important principle that money is generally taxed only once, either when premiums are paid or when benefits are received, but not both. For individual policies, premiums are not tax-deductible and are paid with after-tax dollars, making benefits tax-free. For group policies, taxation depends on who pays the premiums. Employer-paid premiums are tax-deductible for the employer, but result in taxable benefits for employees. Employee-paid after-tax premiums result in tax-free benefits. Understanding disability insurance fills a critical gap in financial planning. While clients may focus on protecting against death or property damage, disability insurance protects their most valuable asset, their ability to earn an income. Keep reinforcing these concepts. Exam questions often focus on key definitions such as disability, benefit eligibility, waiting periods, and tax implications. You're making great progress. Your growing expertise will serve you well both on the exam and in your future career. You're getting closer to being fully prepared to pass with confidence.
All right, let's firstly do the questions. And chapter 17 will be health insurance plans for seniors. The kind of that's what we're going to see on chapter 17. It's a very little chapter, it's not big. Then chapter 18, which is almost the second to the last chapter, we're going to look at the provisions, health insurance policy provisions. There we're going to see 2 types of provisions and clauses. The provisions are, I think there are 23 provisions. Out of those 23 provisions, we have the one that is beneficial to the insured and the one that is beneficial to the insured. So we're going to look at it. Of course, chapter 19 will tell us on health insurance underwriting and policy issues. Chapter 19 is always a very easy, there's a lot of chapters, but it's very interesting. It's just going to teach us all. So let's do this exam on chapter 16. It's only 12 questions. So remember the way you answer these questions. Do within yourself, do elimination method, remove two options. If you don't, let's assume you don't know any of the questions, try and eliminate two options out of it, and do not waste your time in reading it. Waste your time in one question, because if you keep on wasting your time in one question, it's going to affect your time during the real exam. So read through it. We'll read through it as fast as you can, then go through the options. Don't waste your time in two. Just clear two out and concentrate in making the right option, the right choice from the remaining two options. Then that way, help you not to waste much of your time. Right, this one says, which of these statements concerning an individual disability income policy is true? Which of them is true? Individual disability income policy. Which of the option is true?
D.
Any other person? Any other person
D,
supporting her?
okay.
Huh? She said D. Normally includes an elimination period, of course. Benefits are normally taxable. Is benefit taxable? Is there benefit taxable in disability income insurance?
No.
All right. Premium are normally tax deductible. Is it tax deductible? No. Age of the insured determines the amount of benefits. Is that true? No. This one says X owns a disability income policy. X recently suffered a disability, which was due to the same cause as previous disability. This disability both cover occurred over a 4-month span. Which of the following provisions allow X second disability to be covered without a new elimination period? We talked about that yesterday.
The recurrent disability.
A.
Is recurrent because remember,
First one is
within 4 months. It must be at least 6 months before they can open up another elimination period for him or period. So he becomes ill after traveling and is unable to work for 3 months. What kind of policy would cover her loss of income?
disability.
Yeah, that's disability.
That's called disability income. M becomes disabled and is unable to work for 6 months. M dies soon after from complications arising from his disability. M has a disability income policy that pays $2,000 a month. Which of the following statements best describe what is owed to her estate? It doesn't have any beneficiary. So, which of the following statements best describe what is owed to her estate?
C.
Somebody say C?
Yeah. I don't know. I just
C
say
or D. D is D.
and but unpaid benefit. Okay.
Yeah.
Makes sense.
So it's end but unpaid benefits.
Because he has the coverages.
Yeah. So non-occupational disability coverage is designed for what? Non-occupational.
Non-occupational.
Yeah, we talked about non-occupational,
Yeah.
non-occupational and occupational.
Those who are exempt from workers' compensation. So Employees who suffer non-work related disability, since work related disability are covered.
A.
Sole proprietors.
Not A.
So
I would think A.
A.
I would think A.
Someone
Let's
say
see. A.
Pick A.
all right. Employee who suffer non-work related disability, since work-related disability are covered by workers' comp. So did you guys see? I want everybody to look at that answer and look at what workers' comp do and what disability can do. Workers' comp only covers work-related disability. Because when you start business, you see that some people you're going to talk with will tell you that, look, I get it all. I get workers' comp. I get this. I get. So sometimes they will tell you all those that they have. Say they have it all. They don't have nothing. No, please tell them. No, I'm telling you, they don't have nothing. So if somebody have workers' comp now, that person will jumping up and say, I have insurance. Yeah. But it's only for what? Work-related injury. So which means if you don't have it at work, if you don't have the injury at work, nothing. So as the group insurance we have at work, if you are sick, they tell you to go home because it's only effective when you die at work and die on that clock. If not, nothing. If not, nothing. So as we continue to do this, our eye will open. This one's the second one. This one said V is insured under an individual disability income policy with 30-day elimination period. On July 1, he is involved in an accident and temporarily disabled. He returns to work on December 1. How many months of benefit are payable? So you have to know what elimination period is.
Elimination period, which is like a 6 months, 5 months?
That's 4 months.
5 months.
No. 4. I would say 4.
It's D.
I would say C. C.
Did you do the calculation?
No.
3 months.
Check it again because you may see this kind of thing in the hall. Check everyone, read it again. Think somebody get it right, but read it again. Interpret your own answer.
Oh, okay. So
You can see it in the exam. And definitely this kind of question.
When you have 30 days elimination period, it means that means the benefits will start. Is it 31st? If there's a 31st month, it will either start 31st or it starts 31st. If you have 30 days.
All right. So everyone
Right,
has looked at it. So the correct answer is 4 months. After the 30-day elimination period has been satisfied, there will be 4 months of benefit payment. Here they tell you that the policy with 30-day elimination period. I've already told you the elimination period is 30 days. So thereby you have to remove the 30 days. So whatever remains becomes the benefit period.
okay, I messed
You
up.
remember the elimination? What is the elimination period? From the time the incident happened till when you start to receive your what? Benefit.
Benefit.
So that definition will just help you. Then the benefit period now becomes from the time the elimination period stopped. Now, from the time the payment, when the payment ends, becomes what? The benefit period. So if you know all those, that will help you to answer this kind of question. Now, which of the following actions may not be taken by an insurance company to ensure a substandard applicant for disability income coverage? Remember what substandard risk? You know what it is.
They not cover the substandard condition. Limit the type of coverage. Lengthen the can do that. Yes, premium. Let's B.
B. Lengthen the contestability period.
Let's B. What they cannot do. Yeah. That's B.
Lengthen what? The contestability period. Of course, they cannot do that.
Mm.
All right, this one said Z is this a scenario question? Z owns a disability income policy with a 30-day elimination period. Z contracts pneumonia that leaves him unable to work from January 1 until January 15. Z then becomes disabled from an accident in January 1st, February 1st, and disability lasts until July 1st, the same year. Z will become eligible to receive benefits starting on what day?
Disability.
First to January 15, and this, then it's a 30 days.
Disability income policy.
Now the
Around March.
March 1st.
March or 1st.
March 1st.
March 1st, all right.
I would think so.
Yeah. So how did you do it? Because this is
From
typically what you're going to see. How did you do it?
January. Okay. Go ahead, sir.
How did you do it? I say, how did you get March is correct answer. How did you get March first? Tell others.
From
Somebody say
yeah.
March 1st,
This-
and I
this
think March 1st
contract
is the correct answer.
pneumonia that leaves him unable to work from. So from January 1st to January 15, he was unable to work. And then February 1st, he becomes disabled from an accident.
Mhm.
So that means January 15 through February 1st, he was unable to work.
Mhm.
And then disability lasted till July 1st. So you have January, February. You have January, February, March, April, May, June. That is 6 months. He was at home 6 months.
Mhm.
And so you have a 30-day elimination period, which ended when? Is it February 1st? February, sir.
Mhm.
And
Mhm.
so within that period, I don't know how to, I don't know how to think, but within that period of that time, he didn't work. So they will back pay him from March 1st.
From March 1st, correct.
Yeah.
So
I don't know if you understood. Though.
the key thing to this is you knowing what is the elimination period.
Yeah.
Knowing that you have to remove the elimination period before the benefit period starts. That's just the key. That's what will be in your mind. Removing the elimination period, take off the elimination period. The time the benefit period starts is definitely when you're going to start calculating from. So that is exactly what you need to know. This one is not all that. It's not somebody will see calculation. He say it's calculation. Look at it. It's not calculation. He said an insured owns an individual disability income policy with a 30-day elimination period for sickness and accident and a monthly indemnity benefit of 500. If the insured is disabled for 3.5 months, what is the maximum amount they would receive for an approved claim?
Hold on.
Check well. Well. This is an insured owns an individual disability income policy with a 30-day elimination period for sickness and accident monthly indemnity benefit of what? 500, which means every month he is paid what? 500. So if the insured is disabled for 3.5 months, what is the maximum amount he will receive for an approved claim?
So 1,750, something like that, yeah. So 1,500 for 3 months. Then the remaining, yes, I think it's A.
The A is 1,250. C, 1,250.
Somebody say 1,250.
So,
Good. So how did you
Yes.
get it?
How did I get
Yeah.
it? You know, I've done the exam
I
before.
want to
Like
say
I
it's not
haven't.
guess. I want to make
It
sure
was
it's not
disabled.
guess.
No, it was disabled for 3.5 months. So you
Uh,
take the 3 months
mhm.
and you add it to the, I don't know, to get the 3.5 months. Then from the 3.5 months, you minus, I
Oh,
think you
the
eliminate.
elimination.
Mm,
Mm.
elimination period was, I think, 1 month now. That's the 30
Yeah.
days, which gives you 2.5 months. And then you multiply the 2.5 months by the benefits, that indemnity benefit, to give you the 1,250.
yeah, you got it. So basically, this man is disabled for what?
Three
Three
and
and
a
a
half
half
months.
months. And what is the elimination period? 30 days.
30 days.
Mhm.
Yeah.
So 30 days is the month he's disabled,
Is
which
1
is
month.
3.5 months is 3 months and 3.5 months, which is 3 months. Now, in
Yeah.
that 3 months, you have how many elimination period? 30-day elimination day, which
Yeah.
is 1 month.
Okay.
Minus 1 month from 3.5 months. What remains is
That
2.5 months. So
that
two and
is
a half
how
months,
I.
then he gets 500 every month, 500 every month. So for 2 months, he gets what? How many? 1,000.
1,000.
Then for half month, he have 250 months. I mean, $250.
That's 500. Okay, 250.
Yeah, I didn't
So,
remember to
so you,
minus
you,
the.
you can see that whenever you see mathematics in these questions, it's not really mathematics. It's trying to test your knowledge. For instance, you have to know already everything is given to you here. The indemnity benefit. Indemnity is the what? The payback, the payment they're paying him. The reimbursement is $500 every month. That's what the benefit is getting. $500
See, they also demonstrated that by saying correct 3.5 months minus 1 month elimination period, because see they did it here. So
yeah, that's the rationale. They did the rationale.
yeah, which is good.
So you see this kind of thing, don't get freaked out. Then B is a teacher who was injured in a car accident and cannot walk. A teacher. He was injured in a car accident and cannot walk. She is now
She's
receiving monthly benefit as a result of this accident.
this
So
actually
which type of policy does B have?
Disability.
disability.
All right. Good. So I think probably all of them was correct. All right, 8
So
of
we
what?
have 80.
8. All right, 80. All right.
So we missed one. That one that was,
Mm.
yeah.
All right, so that is it for chapter 16. That is good. Come on, what's going on here? Just log me off. All right. So chapter 17 is almost it's 10 o'clock already. So chapter 17 is what we supposed to look at. That is health insurance for the senior people. What kind of insurance do they suppose have? It's going to give us much education on the kind of things, the health insurance, which is likely someone trying to prepare his retirement, That's basically what it is. Preparing your retirement. If you don't have it, it's a big problem. If you don't prepare the retirement, it's a very, very big problem, I tell you. So, but that doesn't make anybody, it depends on when you begin to know what is going on. Nobody's to be blamed.
in the next 3 months.
You can't say you blame somebody for that. No, you blame yourself. No. It's about when you start getting the knowledge. So no time is a waste. Anytime you start getting the knowledge, do as much as you can. So let's look at health insurance plans for seniors. When you navigating healthcare options for seniors can feel like trying to solve a complex puzzle. As Americans live longer, understanding what healthcare landscape after age 65 becomes increasingly important, not just for seniors, but for the family members and insured professionals who help them make these critical decisions. At a point in life, you have to help somebody to be able to make decisions. I hope everybody knows that. At a point
That's
in
right.
life, somebody needs other people to be able to make decisions. If you don't help people, they cannot make a good decision. So, but our aim now is to try to make those decisions before it reaches the stage that somebody can help us to make the decisions. So, if we make the decision before we become seniors, which means we have to get all these things intact before we come to this point where other people will help us to make the decision. If you do that, then that's when they say some person had made a good progress in preparing for his or her retirement. So imagine the scenario. Maria just turned 65 and received her Medicare card in the mail. She is overwhelmed by the choices she needed to make. Should she stick with original Medicare or choose Medicare Advantage plan? Does she need a Medicare supplement policy? What about prescription drug coverage? And looking further ahead, should she consider a long-term care insurance to protect her savings if she eventually needs nursing home care? These questions represent the reality faced by approximately 10,000 Americans who turn 65 each day. The decision they make about their health care coverage will significantly impact both their physical and financial well-being for years to come. So in this chapter, we're going to unravel the complexity of senior health insurance plan. We will explore the structures of Medicare, from hospital coverage under Part A to prescription benefits under Part D. So we will examine the difference between original Medicare and Medicare Advantage plan and how Medicare supplement policy help fill coverage gaps. Finally, we will look at long-term care insurance as a critical component of comprehensive senior healthcare plan. So we're going to see Medicare Part A, Part B, and Part C, and Part D. We will see where do we have to have Part C that do the job that Part A and Part B cannot do. Of course, why do we have supplementary policy? What is the function of Part D, the prescription drug? And what's the need of having Part A and Part D, Part A and Part B, for you to have a good Medicare coverage? So these are the things we're going to look at. And that will now give us the understanding of what part we have. And if we don't have, the part we should apply now to have if we are seniors. I think this, all right, let's just watch the video. While you're watching this video, I think after the video, we're gonna stop in the evening. We're gonna do it. It was 10 o'clock. I already joined and done it.
Welcome to the Health Insurance Plans for Seniors chapter, where we'll break down the complexities of senior health insurance options. Understanding these plans is not only essential for guiding clients through one of their most important retirement decisions, it's also key to helping you succeed on your exam. Imagine this scenario. Tara just turned 65 and received her Medicare card in the mail. She's overwhelmed by the choices she needs to make. Should she stick with original Medicare or choose a Medicare Advantage plan? Does she need a Medicare supplement policy? What about prescription drug coverage? These questions represent the reality faced by approximately 10,000 Americans who turn 65 each day. The decisions they make about their healthcare coverage will significantly impact both their physical and financial well-being for years to come. By the end of this chapter, you'll be able to explain the 4 parts of Medicare and identify the services covered under each part. Distinguish between original Medicare and Medicare Advantage plans. Identify Medicare eligibility requirements for both seniors and qualifying individuals under age 65. Describe the various Medicare enrollment periods and explain the consequences of delayed enrollment. Explain how Medicare claims are processed and the rights of beneficiaries to appeal claim decisions. Compare the standardized Medicare supplement plans and identify their core and additional benefits. Identify the 3 levels of long-term care and describe the various settings where care is delivered. Explain the benefit triggers and qualification requirements for long-term care insurance. Describe the tax considerations for qualified and non-qualified long-term care insurance policies. And explain how Medicare, Medicaid, and long-term care insurance work together to address seniors' health care needs. In this chapter, we'll unravel the complexities of senior health insurance plans and explore the structure of Medicare, from hospital coverage under Part A to prescription benefits under Part D. We'll explore how Medicare supplement plans help cover the gaps left by original Medicare, and how Medicare Advantage plans provide a private managed care alternative. Finally, we'll look at long-term care insurance as a critical component of comprehensive senior health care planning. To excel on your exam, it's essential to understand these programs thoroughly. Mastering this material will equip you to answer exam questions confidently and demonstrate your ability to make informed decisions in today's complex healthcare environment. So let's get started. Take a moment to settle in as we explore the world of health insurance plans for seniors, knowledge that will serve you well both on your exam and in your future career advising clients.
All right. So we're gonna stop here. In the evening, we're gonna deal with this. This topic is so vast and it's very important for everybody because everybody one day must be a senior. And the earlier you start planning for it, the better for you. So we're gonna deal with it in the evening. Senior, how do they start to planning for their retirement? The things needed, the kind of policy they needed to start planning. And if you're senior already, you will now begin to see what kind of policy you need. If you don't have it, you do adjustment immediately. Because every time you start is good. It's bad when you don't start at all. But if anytime you start, it's good for you. So this is a very good topic I want everybody to be in to see it. We're gonna talk about all the Medicare, all the Medicare. Why are they necessary, and what we do, and why at all we should not even hope on them. Why we should not hope on them? That's another issue that will come up. We're going to discuss with you. So I'll see everybody in the evening by 6 o'clock.
Thank you.
See you at 6 o'clock. All right.